Welcome to Learning Unit 2, Concept and Terminology. In Learning Unit 1, we define the environment. We establish what accounting is, who uses it, and what makes information useful, and the forms a business can take. We drew the map. In this unit, we name the pieces on the board. Take the word vocabulary seriously. Every discipline has a small set of words that carry enormous weight, and using them loosely is the fastest route to a set of accounts nobody can trust. Here is the whole of this learning unit in one sentence. Every physical item and every financial event in a business must be sorted into one of five bins: assets, liabilities, equity, income, or expenses. Five bins. That is the entire classification system, and you will use it for the rest of your career. Sorting is not clerical work, it is the substance of accounting. A cost placed in the wrong bin misstates profit. By the end of this session, you will be able to define each of the five elements, distinguish current from non current items, explain how equity moves, and calculate the net worth of a business from raw data. We start with a question you already know the answer to, even if you've never framed it in accounting terms. How wealthy are you? Not the business, you. Let us work through it with the figures on the screen, because the logic you use here is precisely the logic a hotel group uses on a much larger scale. Start with what you have: a racing bicycle worth 2,800 rand, a chef's uniform and knife kit 600, clothing 2,520, a fitness watch 3,000, and cell phone 2,000, and 550 rand sitting in your bank account. Add those together and you have 11,470 rand of possession. Now, what do you owe? A loan from your father of 2,500 rand, a loan from your mother of 1,850, 4,350 rand of debt. Take the debt away from the possessions. 11,470 less 4,350 leaves 7,120 rand. That figure is your net worth. It is what would genuinely be yours if you sold everything you own and settle everything you owe on the same afternoon. Notice two things, because both carry into the business world. First, the possessions are listed at what they are worth now, not at what you paid for them. Second, on this, many people are caught. The loans from your parent are real debt. It does not matter that they will never take you to court or that nothing was written down. An obligation you have to settle is an obligation, whatever the relationship behind it. You have just performed an accounting calculation. All that remains is to learn the professional word for it. Think of this slide as the Rosetta Stone of accounting. The same three ideas in two languages. slide by slide. In the personal language, you have possessions. In the business language, we call those assets. And notice the definition attached to it: what the business controls, not what it owns. Control, not ownership. Hold that distinction because we will come back to it in a few slides. And it is one of the sharpest edges in this unit. In the personal language, you have debts. In the business language, we call those liabilities. Amounts the business is obliged to settle. In the personal language, what is left over is net worth. In the business language, we call it equity, the true value of the business and the portion that belongs to the owner. Three words: assets, liabilities, equity. Learn them precisely and use them precisely. In everyday conversation, people say a hotel is worth 200 million rand when they mean its buildings and land are worth 200 million rand. Those are different statements. The first is equity. The second is one line of asset. If the property carries a mortgage bond of 240 million, the difference between those two numbers is 60 million rand of somebody's money. And these terms are universal. They mean the same thing whether you run a single guest house, a two partner restaurant, or a hotel group listed on the Johannesburg Stock Exchange. That universality is what makes financial statement comparable across businesses and across borders. And comparability, you will remember, is one of the enhancing qualitative characteristics from learning unit. Here is that relationship expressed as a formula, and this is the single most important line in this learning unit. Total asset minus total liabilities equal net asset value, which is equity. Look at the diagram. The full bar represents everything the business controls: total assets. Part of that bar is claimed by outsiders: the bank, the suppliers, anyone the business owes. That is total liabilities. Whatever is left after those claims have been met belong to the owner. That remaining block is equity. I want you to notice the word order because it is deliberate. Assets come first, then liabilities are deducted. Equity is what is left. Equity is a residual, a leftover, not something calculated in its own right. That is why the formal definition of equity, which we will meet shortly, describes it as the remaining interest in the assets after deducting all liabilities. Three consequences follow from that, and each one appears in assessment. First, if liabilities are greater than asset, equity is negative. The business owes more than it controls. In everyday language, it is insolvent. Second, equity changes whenever assets or liabilities change. It has no independent life. Repay a loan and both sides fall by the same amount, leaving equity untouched. Earn A night's accommodation revenue and asset rise while liabilities stay flat, so equity rises. Third, and in this is the connection you should carry into learning unit 3. Rearrange this formula and you get assets equals liabilities plus equity. That is the accounting equation, and it is the foundation of the double entry system you will spend the next unit learning. The formula on this slide and the accounting equation are the same statement, written two ways. Now, let us take each element apart, starting with assets. The formal definition of an asset has three parts, and every one of them has to be satisfied. If any one fails, the item is not an asset. Assessments test thus by giving you an item that satisfies two of the three. So read them carefully. First, controlled by the entity. Notice what the definition does not say. It does not say owned, it says controlled. Control means the business can direct the use of the resource, obtain the benefit from it, and stop others from doing so. A hotel operating a shuttle vehicle under a finance lease may not hold legal title, but it decide where that vehicle goes and who it carries. It controls the vehicle. So the vehicle is its asset. Accounting follows economic substance, not legal form. Second, resulting from a past event, the transaction giving rise to the resource must already have happened. The purchase made, the delivery received. In the example of the hotel that intends to buy a laundry press next year has no asset today. Intention is not a past event. Third, from which future economic benefits are expected to flow. The resource must be capable of generating cash or value going forward. Guest rooms generate accommodation revenue. Kitchen equipment produces meals that are sold. If an item can no longer generate any benefit, a walk in refrigerator, for example, failed beyond repair and worthless, even as scrap, it has ceased to be an asset, whatever the invoice once said. Put the three together. An asset is a resource the business controls, arising from something that has already happened, that will produce benefit in future. The takeaway on the screen put it plainly. Assets are the foundational resources that allow a hospitality business to operate and generate revenue. The building, the kitchen, the vehicles, the stock, the cash, every one of them exists to be turned into revenue directly or indirectly. Assets are not a single, undifferentiated pile. We saw them along a time horizon, and the dividing line is 1 year. Non current assets have a lifespan of more than 1 year. These are the permanent infrastructure, the things you buy in order to use, not in order to sell. Hotel land and buildings, kitchen and laundry equipment, shuttle vehicles, franchise rights, fixed deposits, On the liquidity scale, they sit at the low end. You cannot turn a hotel building into cash on Friday afternoon. Current assets have a lifespan of less than 1 year and are expected to be converted into cash within the normal operating cycle. Food and beverage inventory, the trading stock, datas which are amounts owed to you by tour operators and corporate clients who have bought on account, petty cash, the bank balance, the cash float in the till. These sit at the high liquidity end. They are already cash and they are on a short and predictable path to becoming cash. 2 points of precision. The first is that the test is not what the item physically is, it is what the business intends to do with it and how long it will remain in the business. That is the trap in the checkpoint on the next slide. So hold the thought. The second is why we bother with the split. It is a question about survival. A lender wants to know whether your current asset can cover your current liabilities, whether the cash coming in over the next 12 months will meet the obligations falling due in the same 12 months. A hotel can be rich in buildings and still fail to pay its staff. Sorting by time horizon makes that visible. Let us now test the principle. Here is the checkpoint. If you have not yet answered it, pause the recording before I give you the answer. The scenario is this: you run a computer store, you buy two identical computers. One goes onto the manager's desk to run the store's daily administrative software, the other goes onto a display shelf to be sold to a customer. How do you classify each one? The answer is on the screen, and it surprises people the first time. The computer on the manager's desk is a non current asset. The reason is that it is being used as infrastructure to run the business. It will remain in the business for more than a year, generating benefit indirectly by supporting operations. It is equipment. The computer on the display shelf is a current asset, specifically trading stock. The reason is that it is held in order to be sold and it will be converted into cash within the normal operating cycle. It is inventory. Two identical machines, both on the same invoice from the same supplier at the same price, two entirely different classifications. So, what actually determines the answer? Not the object, for sure, the intention behind holding it, and the length of time it will remain in the business. The principle runs throughout hospitality. A case of wine held to be poured for guests is trading stock, a current asset. The same wine bought as an investment to be held for a decade is a non current asset. When you are asked to classify an item in an assessment, do not ask, "What is it?" Ask, "What is the business doing with it?" Now to the second bin, liabilities. And You will notice the definition has the same three-part structure as the asset definition, which is not an accident. It is a mirror image. First, a present obligation. There must be a duty or responsibility to act or perform in a certain way, and it must exist now. The obligation is usually legal, a contract, a loan agreement, an invoice from a supplier, but it can also arise from established practice, such as a hotel with a long-standing policy of refunding guests for service failures may have a genuine obligation even without a signed contract. The second, resulting from a past event. Again, the triggering event must already have happened. The loan has been advanced, for example. The supplies have been delivered. The staff have worked the shift. This is why an intention to borrow money next quarter creates no liability today. And it is why a signed contract for a service that has not yet been performed by either party creates no liability either. Third, a settlement of which will lead to a decrease in economic benefit. Settling an obligation will require cash and other assets to flow out of the business. That outflow is the defining feature. A liability is, in essence, a future outflow that has already been committed to. Hold the two definitions side by side because the symmetry makes both easier to remember. An asset is a past event producing a future inflow of benefit the business controls. A liability is a past event producing a future outflow the business is obligated to make. Same structure, opposite direction, which is exactly why they sit on the opposite side of the formula. Liabilities are sorted the same way assets are along the same 1 year time horizon. The consistency is deliberate because it lets the reader line the two sides up against one another. Current liabilities are obligations payable within 1 year. For example, a bank overdraft. This is what your bank balance becomes when it drops below zero. Note the classification carefully because students get this wrong. A positive bank balance is a current asset, and a negative bank balance, an overdraft, is a current liability. It is the same bank account. Which side of the statement it appears on depend entirely on which direction the balance has gone. And creditors, also called accounts payable or trade payables. These are the suppliers you owe. Your food and beverage suppliers who delivered on 30-day terms. The municipal accounts for water and electricity. All these are examples. Anyone who has given you goods or services and is waiting to be paid. Non-current liabilities are obligations payable over a period longer than 1 year. The mortgage bonds over the hotel property, a 5 year equipment loan from the bank. These are the long horizon commitment typically taken on to acquire non current assets, which is a sensible pairing. You finance a 20-year building with a 20-year bond, not with a 30-day supplier account. One refinement to plant now for later unit. A long term loan does not stay entirely non current. The portion of a 5-year loan falling due within the next 12 months is reclassified as current. The rest stays non current. Classification follows the timing of the repayment, not the label on the agreement. Asset and liabilities are now both in place. That means we can look at what is left in the middle. Equity, the honors slide. Look at the picture on the screen because it is the clearest way to hold this idea. The full circle is the total asset, everything the business controls. One portion of it is claimed by outsiders, that is total liabilities. What remains is the owner's slice, and that is equity. The formal definition follows directly. Equity is the remaining interest in the asset of the business after reducing or deducting all liabilities. Now, a point that trips up almost every student. From business's point of view, equity is something the business owes to the owner. Surely the business belongs to the owner. So how can it owe the owner anything? The answer is a principle you will use for the rest of the course, the business entity concept. For accounting purposes, the business is a separate person from its owner. Even where the law makes no such separation, especially in the case of sole traders. So, when the owner puts money in, the business has received a resource from an outside party, and that party happens to be the owner. Once you accept the separation, the two modifiers on the slide follow naturally. Capital with a plus sign is the investment the owner makes. The initial injection and any further contributions. The business receives asset and its obligation to the owner grows. So the slice expands. Drawing with a minus sign is the reverse. Asset taken out for the owner's personal use. Cash withdrawn. Stock taken home. The business hand asset back. So the slice shrinks. Say this to yourself and remember it. Drawings are not an expense, they are a reduction in equity. The distinction is the whole point of the diagnostic trap we will reach in a few slides. And capital and drawings are only two. So far, we have described the business at a single moment, what it controls, what it owes, and what is left. That is financial position. Now we turn to financial performance, how the business did over a period of time. Performance is measured with one formula: profit or loss equals income minus expenses. Income is receipts arising from normal operations that increase economic benefit. In a hospitality business, that means accommodation revenue from rooms sold, food and beverage sales from the restaurants and the bars, venue hire fees from conferencing and functions, and rent received from the shop that leases space in your lobby. Expenses are the operating cost incurred to generate that income, and they decrease economic benefit. Kitchen staff wages, cleaning consumables, water and electricity, laundry, advertising, depreciation. Two of those are worth pausing on. Depreciation is an expense even though no cash leaves the business when you record it. It recognizes that a non-current assets are that your non-current asset are being used up as they help you earn revenue. This is your first encounter with the idea that expenses and cash payments are not the same thing, and it will occupy much of learning unit 4. The second is the word normal in the definition of income. Income is what the business earns from its ordinary operating activities. If a hotel sells a delivery vehicle it no longer needs, that receipt is not income in the way accommodation revenue is, because selling vehicles is not what the hotel does. Now, why is this slide in a learning unit about the five elements rather than in a unit of its own? Because income and expenses do not lead independent lives. They are the third and fourth forces acting on equity, and the next slide shows how. This slide brings the two halves together. And if you understand this diagram, you have understood the learning unit. At the bottom of the structural foundation, asset minus liabilities, the position of the business at a point in time. At the top is operating performance, income minus expenses, what the business achieved over a period of time. And the arrow between them is the thing to grasp. Those are the two not separate systems. Operating performance flows directly into the structural foundation. Profit increases equity, and loss decreases it. Follow one transaction through. A guest checks out and pays 4,000 Rand for the 2 night stay. The bank balance rises by 4,000 and an asset has increased. No liability has changed. By the formula, equity must have risen by 4,000 Rand, and it has through income. Reverse it, the laundry contractor invoices you 900 Rand, so either your bank falls or your creditors rise. And either way, equity falls through an expense. That gives you the complete picture of what moves equity. Four forces. Capital increases it when the owner puts money in, drawing decreases it when the owner takes value out, income increases it through trading, expenses decreases it through the cost of trading. The first two are transactions with the owner. The last two are transactions with the outside world. That is the cleanest way to hold the four apart in your memory. And it is exactly the distinction the next checkpoint test. The takeaway on the screen is worth repeating. Equity is not a static number. Every profitable service you deliver pumps value into the owner's equity, and every cost drains it. The connection between what a business does day to day and what it is ultimately worth run through this diagram. This is the diagnostic trap, and it is the single most common classification error in small hospitality businesses. The scenario: the owner of the business takes 2,000 Rand in cash from the business bank account and uses it to pay the electricity bill at his own home. The junior bookkeeper record the 2,000 Rand as a water and electricity expense. Is the bookkeeper correct? Posed an answer before I work through it. Now, follow the three steps on the screen because this is a reasoning procedure you can apply to any transaction of this kind. Step one: did cash leave the business? Yes. The bank balance is 2,000 Rand lower, so assets have decreased. Something must be recorded, and the bookkeeper was right to see that. Step two: was the cost incurred in order to generate business income? No, it was personal. That electricity lit the owner's home, not the kitchen and not the guest rooms. Step three: therefore, it is not an expense. An expense is a cost incurred to generate income. This one benefited the owner personally, so it is drawings and it reduces equity. You might ask why it matters, since either way, equity falls by 2,000 Rand. It matters for three reasons. Profit is misstated. Recorded Recording it as an expense understates profit, and profit is what the bank reads when you apply for finance. The expense line is corrupted, so next year's comparison of electricity cost against this year is meaningless, and the tax position is wrong. A personal cost claimed as a business deduction is a misstatement in a return, not a bookkeeping quirk. The takeaway is the business entity concept in action. Always separate the owner's personal transactions from the business's operating expenses. When cash leaves the business, ask one question: did this cost help the business earn income? Or did it benefit the owner personally? Expenses or drawings? Let us put the whole unit to work on a case study. Dr. Dan has opened a dental practice, and at the end of his first month, he reviews his financial position. Here is the raw data: dental equipment value at 75,000 Rand, cash in the business bank account of 15,000 Rand, 22,000 Rand owed to a supplier for material bought on credit, and 30,000 Rand owed to the bank on a long term loan. Work through it in three steps. Step one: identify the asset. The dental equipment is a resource he controls from a past purchase, generating future benefit by allowing him to treat patients. It is an asset and non current because it will serve him for well over a year. The 15,000 Rand in the bank is a current asset. Together, total asset of 90,000 Rand. Step two: identify the liabilities. The 22,000 owed. to a supplier is a present obligation from a past event settled by an outflow of cash. A current liability because supplier accounts fall due within the year. The 30,000 Rand bank loan is non current. Together, total liability of 52,000 Rand. Step 3, execute the formula. Asset minus liabilities equal equity. 90,000 minus 52,000 is 38,000 Rand. Dr. Dan's equity is net worth in the practice is 38,000 Rand. Two observations. Notice that we classify each item as current or non current, even though the answer did not require it. Get into that habit now. In Learning Unit 4, the classification determines where each item is presented and marks are awarded for it. And notice this is the same calculation you performed in the start of the session with a bicycle and two loans from your parent. Same arithmetic, same logic. All that has changed is that you can now name every component correctly. Here is the whole learning unit on one slide. The five beans, populated with hospitality examples. Use this as your revision sheet. Asset, non-current, the hotel property, the kitchen equipment, current asset, beverage stock, corporate datas, resources the business controls from past event expected to generate future benefit. That's our asset. Liabilities, non-current liabilities, the mortgage bond over the building, current liabilities, beverage creditors, the bank overdraft. These present obligations from past event that are settled by an outflow of benefit. Equity, capital being the owner's own investment, and drawings being the owner's personal withdrawals. The residual interest and what the business owes to the owner. Income, accommodation fees earned, interest received, catering receipts, receipts from normal operations that increase equity. Expenses, housekeeping weekly wages, the telephone account, interest paid on the loan, cleaning materials. So all these are costs incurred to generate income, which decrease equity. And that's the definition of expenses. Notice one detail because it rewards close reading. Interest received sits under income, interest paid sits under expenses. Same word, but the direction of the flow put them in different bins. As ask about direction whenever an item looks ambiguous. Two formulas to carry forward. Asset minus liabilities equals equity, and profit or loss equals income minus expenses. Everything in this learning unit connects those two statements. Before your next session, rework the Dr. Dan case study with one further liability of your choosing and see what happens to equity. Then walk through any business you know well and sort 10 of the things you can see into the five bins. As the slide says, mastering this vocabulary is the first step to controlling the architecture of your business wealth. In Learning Unit 3, we take these five elements and put them in motion through the accounting equation, where you will see that every transaction touches at least two of them, and that the equation always balance.